Good afternoon, I guess good day and good morning to everyone. This is Joseph Trevisani from Worldwide Markets. The title of today's webinar, chosen by vote, is the Euro in 2013. Not the most unusual topic, but certainly one which is dominant on anyone who's involved with the trading markets. Also, one might say one who's involved with international finance, with banking, and almost any other topic. The euro, over the past 2 years, one could say 3 years, has very much been the canary for the state of the world economy, much more so than almost any other currency. If you look at the yen, which we will talk about in a little bit, the yen hasn't really indicated anything other than the effect of the collapse in the euro-yen cross and the other carry trade crosses around the financial crisis of 2008. Nothing the Japanese government has done since then, until very recently, has had any effect. So it really has been the euro that has been the indicator, the signpost, the most moving, the currency that moves the most in its pair with the dollar when we have other events or other things happening in the world. Now, I'd like to ask anyone who has any questions. I will keep the chat up. Please put them up as we go forward, and I'll be glad to stop and go off on tangents. Anyone who's been to my webinars before knows that I tend to go off on tangents anyway. So a question may help to rein me back in if we have any topic that anybody's interested in. So let me change screens here. Where's the euro? Here we go. We're talking about the euro. This is a 5-year chart for the euro. It's one that we're all familiar with. But there's an interesting fact of this. You know, we have been talking, and commentators, I hear it all the time. They call it the RORO world. Not a very elegant way to phrase it, but that just stands for risk on, risk off. Much of the commentary has been how different this world is for trading than the old central bank focused world. The old or the prior method of analysis. The greatest correlation in foreign exchange trading and in the movement of currencies has always been related to central bank rate cycles. Everything feeds into that. Will the central bank raise rates? Will the central bank surprise the market? Sometimes they do, very rarely, although less so, much less so now in the United States under Ben Bernanke than they did under Alan Greenspan, the author of my favorite, or the originator of my favorite market quote. I know I've used this. I use this every time, but I like it so much. If you have clearly understood what I said, I must have misspoken. Alan Greenspan liked to keep the markets guessing. Mr. Bernanke does not. But the idea that central banks determined the interest rate, the directions of currencies, turning points when they change their cycles and who's moving first, is one that it seems on the surface we've gotten away from. So when you had not interest rates, but any economic statistics, policy changes, the way they entered into the foreign exchange market was through speculation on what the central bank is going to do. Will this make the Bank of England more likely to lower rates? Will it make the Bank of England more likely to raise rates? And on down the line. That is very different. So this is what we're looking at here. Now, people have said that, and it is true, that over the past year, 2012 was not a very good year for FX volume. FX volume went down. Trading volume went down. But looking at this euro chart, does this look like a bad time for trading? It does not. in here, and I even heard this morning. I was listening to Alan, the Bloomberg surveillance show this morning here in New York, and they had on Alan Ruskin, who is a he's chief, I think, market FX analyst for Deutsche Bank, probably the biggest worldwide foreign exchange bank. I don't know them. I've never met them. His stuff is very good. I have read it. It's very sensible. It's not overly technical. It's large macro pictures, and he's talking about trends. And one of the things that he said, which I don't agree with, is that there have really been no trends since the financial crash, the financial crisis of all of 2008. Does this chart look like a chart without trends? It does not to me. It looks like a chart, in retrospect, of course, full of trading opportunities. I think what Mr. Ruskin was saying, and I should hesitate to speak for a man who is so well versed in the markets, that what has changed is not the volatility. It's the ability to predict trend movement from central bank rate policy. Notice I said central bank rate policy. That has gone away, and we can all look at the reason why. We'll just look at some 30-year, where are the, let me just find the rates here. U.S. generic 5-year bond. Oops, wrong rate. Wrong one, sorry. What we want are the, okay, there we go. Central bank rates. Okay, this is a 30-year chart of the U.S. central bank rate. Well, we all know what that is. It's been 0.25 since then. Look at the UK. These charts are going to be boringly familiar and also the same. Look at this one. This is my favorite, of course. This is Japan. If there's ever been a better indicator of the inability of central bank rate policy alone to spur economic growth or economic recovery, this is the chart. Japan has effectively had zero rates for almost 20 years. Japan is not doing well those 20 years, not as far as economic growth goes. And of course we had the ECB. This is the, we should call that the Trichet bump. This was also the Trichet bump. Mr. Trichet used to like to raise rates. But we can see the reason that the euro, not the euro, but central bank rates are no longer, as Mr. Ruskin noted, I wonder if he's related to the 19th century British art commentator. Anyway, never mind. Why they're no longer tied to central bank rate policy, because central bank rate policy is not moving. All of the banks around the world, to a greater or lesser degree, have taken the same approach to the financial crisis, the recession, and the ensuing debt problems around the world. Make money as cheap as possible and hope it does some good. It probably has done some good. It probably did stave off a lot of disaster. Nevertheless, it is not sufficient by itself to spur economic growth or really to create a recovery. But Mr. Ruskin's comment that the years since the financial crash have been trendless, he didn't say trendless, but they have without many pronounced trends, is not one that I agree with. Look at 2009. Euro from above 1.5 in 2010 to 1. That's a fine trend. Again, reversed, other way, down again. These are absolute trends with an enormous amount of volatility, of course, that you can trade. But the difference is that it's not central bank rate policy that is driving this. Since about the middle of 2011, I would say, it is central bank policy, but not rate policy. Because they can't do anything else with rates, at least not directly, in the sense that they change the interest rate and then the market falls into line. You know, the old cliche, never buck the Fed. It's absolutely true. It remains true. The difference, of course, is this period right here. Central banks were doing, but were active in the rate market as far as QE, certainly in the U.S., less so in in Europe, and they never stopped trying to do it in Japan. But the market was focused on something else. The market was focused on fear. It was focused on economic collapse. It was focused on what it feared might happen rather than what the central banks were doing about it. And those are two very different approaches, too. And that's another reason why, and probably the main reason, why you did see in this period right here a change, a drop in foreign exchange volumes, which is something that has not really happened in about 10 years. It happened, I believe, around the beginning of the euro, and when EBS was taking over some of the pricing taking over most of the pricing in the foreign exchange market. So there have been and remain active trends in the foreign exchange market. Let's look at dollar yen is not a good example, but let's take a look at it anyway. This is, of course, the collapse in dollar yen because of the euro yen. The charts are almost identical. And this here, this last part here, is again the central bank's policy, although not specifically rate policy, is what moved. That's a very nice move, a very tradable move. As soon as the Japanese said, Mr. Shinzo Abe, who's the new prime minister, as soon as it was clear that he was going to win, and it was clear from the very beginning, and he started talking about an inflation target, that is a central bank rate move, a central bank rate policy, eminently tradable, eminently predictable. The same thing with the euro here. Okay? Right here. What is that? Bottom, well, it's a little bit further. It's probably right here, right where this is. What is that? That's Mario Draghi, promising to do everything necessary to save the euro, and then, I think about 2 weeks later, promising to buy as much sovereign debt as was necessary of Spain and Italy to prevent the new vandals, of course. The vandal is a term with historical meaning, of course. I'm sure most of you know. That was one of the tribes, the Germanic tribes, that flooded into the Roman Empire in the 5th century. They ended up with a short-lived kingdom in North Africa. But that's where vandal comes from. They were, as from a Roman point of view, and largely the Romans wrote the history, they were, as all the barbarians were, vandals. They vandalized. They destroyed the Roman state, at least the Western Empire, and they looted. So that's where the term vandal comes from. But right here, this is Mario Draghi's announcement. He should have been riding on a white horse, but he wasn't. That he would save the euro. Nobody in the bond market, because after all, the speculation on the bond market was, and we're going to look at some of that in a minute, was that Spain would be forced to ask for a bailout. That was the topic current at the time. And that is what was driving bond prices lower, especially Spanish and Italian ones, and rates higher. The speculation that if they were forced to ask for a bailout, and part of that would have been by their inability to access the markets, not so much that they couldn't sell their bonds, but they couldn't afford the rates that the market was demanding. So you had sort of a feedback loop here. Well, Mr. Draghi met that head on. He said, if you're going to speculate in Spanish bonds, and that forces the Spanish government out of the bond market and into, now speculation, of course, as used by politicians and journalists, has an onerous term. It should not be. If you and I owned Spanish bonds, and I hope you don't, or didn't, then you had every right, both to yourself and to the owners, the other people you might be working for, to exercise your judgment. And if you think it's dangerous, sell the bond. Get out of the position. That's what traders do. So this was not speculation in the sense that people, in the term in which it's often used in the media, and by central bankers and politicians around the world. So Mr. Draghi met that head on, saying, if the bond market keeps, by its rates, out Spain, forces Spain out of the market, then as soon as Spain comes and asks for a bailout, we will crush the bond market. That's what he was essentially saying. Because he was going to buy up everything he could get a hold of. Now, it wasn't so much that this could transpire as an immediate event, because after all, Spain would have had to ask for a bailout, it would have been approved, terms would have had to be negotiated, long, long process. But it did let the people know that it's time to take profits. And that's exactly what happened. So Mr. Draghi never had to buy a single bond. Mariano Rajoy, I hope I'm pronouncing this properly. My Spanish is weak. My Catalan is weaker. Never had to issue or even hint that a bailout was necessary. I think it's very likely that it will anyway, but he doesn't have to. So, by issuing this policy, this prospective policy, we're back in exactly the same type of environment that, and this has been a little bit recent. As I said earlier, through this period here, it seemed very much like central banks were playing catch-up. They were not determining, they were just responding. And not only that, but that their responses were not terribly effective. Well, a lot of nervous people back here. So everyone was concerned that we're in a new environment, and nobody knew quite what was going to happen. Nevertheless, my point is that all of these trends, now these are maybe more ragged, certainly, than you would have seen, say, as an example, in the great carry trade run-up in the 5 to 7 years before the crash of 2008. Nevertheless, these are eminently tradable, and the recent moves that we've seen in the euro and the yen are central bank-driven, standard types of foreign exchange trends. They're historical. Historically, it's been the central banks that drive foreign exchange trends. And even though it's different now that we're not basing on rate policy, there is no difference. The central bank are again driving the foreign exchange market. Here, something else is driving the foreign exchange market. So, now let us look at the actual trends or some of the factors for the euro this year. Let's take a look at, first of all, at GDP. Euro GDP. Okay, this is EMU GDP over the past, actually the past 10 years, I believe, on a year-to-year percent change. I did year-to-year because I wanted to get the equivalencies. The U.S., everybody does it quarter-to-quarter and year-to-year, but the U.S. does their quarterly figures on an annualized basis, which really I think nobody else does. So I tried to get a comparison. So, where can we expect? Now, it's interesting to compare this chart with the euro chart. All right, there's the GDP chart, and GDP is probably the greatest factor in central bank rate policy. Economy speeds up. The central bank is worried about inflation. They hint, and then they start raising rates. The currency goes up. So if we look here for just 2011 and 2012, the past 2 years, The euro economy has performed dismally. That, of course, is largely due, not only largely due, to the austerity and other factors in Europe, but it's also true that, I mean, you'll see a different chart when you see Germany, because Germany is the premier export nation in the world, but it's also due to slowdowns in China, potential slowdowns in the United States. So it's not only that the Europeans have a faltering economy, so does the rest of the world. But during that same period, 2011 and 2012, oops, is this the euro? Yes, this is the euro. You had also a correlation between the decline in the European GDP and the decline in the euro. Now, the interesting factor here is that these are not directly related. Normally, this is the kind of chart you would see correlated with a declining or a fall in GDP, expecting that the central banks will reduce rates to boost the economy. But in fact, as we all know, what was going on here was the debt crisis. It was the continuation of the debt crisis and the speculation, the threat to the euro, to European sovereign bonds. But from a trading point of view, it's the same thing. The debt crisis has been the major factor in the euro-dollar rate since the crisis, since the fall of 2008. Up until this part right here, and as we saw in the yen a little bit later, it has been the tribulations, the rise and fall of what's going on in the European debt as reflected in the risk-on, risk-off environment in the world's currency markets. I'll answer that, Carlos, I'll answer that question. I'll repeat it and I'll answer that question in 1 second. So the reactive policy of the central banks sort of obscured, for many traders, I think, the idea that this was a tradable market with trends. It was. It's just that the trends weren't based on central bank rate policy. They were based on events. Now, the problem with that as a trend is that central bank rate policy in general is a very predictable item. You get some fluctuation around turning points. You get some fluctuation about whether the policy is going to continue, whether it's this month or 6 weeks from now. But by and large, central banks want stable, predictable policy because, after all, their job is to foster economic growth and health in the economy, and businesses and everybody else thrives much better under predictable policies than under skittish and unpredictable events. The difficulty of the European debt crisis, and also, of course, the financial crisis, is that events took on a much greater degree from a market point of view of unpredictability. And if you are depending for the trend, the continuation or the reversal of a trend on events, and events that are not entirely unpredictable but dangerous, it becomes much more difficult to treat those in the same sort of trend-aware, with the same sort of trend-aware trading decisions that you have in central bank rate policy. So there is a pronounced difference in the trading this period here and this period here. Here, you are interpreting news and events. Now, throughout this period, the European Central Bank and European politicians and governments in general were attempting to ameliorate, to improve, to sort of break the back of the debt crisis. They failed several times, and you can see by this. It does seem, although we're nowhere back to these levels, that the central bank has succeeded this time, because after all, the central bank at this point, Mr. Draghi, the summer of 2012, is doing what any normal central bank would do in a situation like that. That's what the Fed would do. Let's look what the Fed has been doing. The Fed doesn't ask any questions. The Fed has no one else to gainsay it. It goes out and does what it wants to do, what it thinks is best. The ECB is a very different sort of organization. But what Mr. Draghi did in the summer of 2012 was essentially what any strong central bank would have done. It took almost 3 years for the ECB and its constituent parts. It had to be pushed to that wall, basically, by the markets, to then come up with what's essentially a standard central bank rate policy. After all, central banks are the lender of last resort. That's their historical, their classical role. And if that is their purpose, and if the governments that constitute it can't borrow in the markets, they get it from the central bank. After all, are we talking about what the Fed is doing? No. Because the Fed didn't have to come to this role. It just assumed it. I know I've mentioned this before, but the U.S. Central Bank, the Federal Reserve, is buying somewhere around 70% of new Treasury issues. And I know I mention this every time because I'm just so astonished by it, but not really. The world accepts it, but it has about as much reality, except that the Fed can do this because it prints its own money, as you owing the bank a credit card, $10,000 on your credit card or 10,000 euros, and you write the bank a letter and say, here, I have new Joseph euros, or Carlos euros, or anybody euros, Maud euros, and I'm giving you 10,000 here. Now I'm paid off. That's exactly what the Fed is doing. So it is a normal function for a central bank as a lender of last resort. Ideally, you're not the lender of last resort to your own government. You're a lender of the last resort to the banking system. But since both in Europe and the United States, the two are essentially the same now, especially in the United States where there's official too big to fail policy, that if you're lending to the government, you are lending to the banks, and you're keeping the whole financial system stable. So, it's not an unusual event. Let me look at this question right now. What impact would a strong U.S. recovery have on the euro looking now from July 2012 until now? Would the correlation have been stronger or an increase for risk appetite? You see, we're not yet, this is the issue that I'm trying to delineate here. We are paying attention to central bank rate, to central bank policy, but we're not really paying attention to central bank rate policy just yet. So if you get a stronger U.S. recovery, especially with Mr. Bernanke and the FOMC's recent focus on unemployment, specifically 6.5%, then the speculation would be in the markets for a withdrawal of the amount of QE. And you would get the normal reaction. And what is that essentially, QE? It's lower interest rates, by another name, because they can't lower interest rates anymore until they start paying you, charging you for deposits, which one or two banks have done. The Swiss have done that. UBS did that. So you do get, with a stronger U.S. economy, the standard type of FX reaction, higher rates, or in this case, a withdrawal of QE, which is a withdrawal of liquidity, which ends up being a withdrawal or a heightening of interest rates. So that would be the normal speculation. So if the euro, as Carlos said, if it was stronger from 2012 or stronger from now on, I think you would get a stronger USD, which is also an increase for risk appetite. Now, the difference we have here, and this is where we may, with the success of the ECB and perhaps Japan, in sort of returning dominance to the central banks, that their policies are going to dictate markets. You may see the first signs, and we've been waiting for this for several years, of a return to some of the fundamentals, away from fear and fundamentals, because the standard response that we're seeing through this era here, right here, has been as risk is perceived to retreat, the dollar falls. Because through this period here from 2008, I would say to the summer of 2012, I think we're going to end up viewing this period from fall of 2008 to the summer of 2012 as the period of high risk aversion correlating to a stronger dollar. That is the entire history of this period right here. As every time the European debt crisis heats up or has a problem, the dollar goes up, the euro goes down. Now, the euro going down is fairly normal, but throughout all of this period, the U.S. economy was performing quite poorly. Not terribly, but poorly. It was performing better than the European, but none of these turning points and none of these moves related to a increasing divergence between the performance of the U.S. economy and the performance of the European economy. They relate to perceptions of risk related to the European debt crisis. So my mouse is being a little skittish today. So from this period here to here, I would view that unequivocally, we've already passed through the period, as the dominance of the RORO, the risk-on, risk-off factor relating specifically to the U.S. dollar and to everything else that goes on. Because, of course, this is the most dramatic indication that there is of the dominance yet, as far as safety goes and perception, of the U.S. economy, U.S. treasuries, and everything else after we have the reserve currency, by the world's financial markets. It's right there. You can't miss it. And that will happen again and again and again, because that is, after all, it's a matter of choices and not absolutes. Okay, so the question we're seeing now is, are these moves, and also, it's just now been 1, 2, 3, more than 3 years, 3.5 years. You can't stay in a crisis environment. I don't care how many times the European debt crisis is called a crisis. At some point, it's stopping a crisis, and it becomes the status quo. And that's what we've seen now. So we may be seeing here a return, and this relates to Carlos's question, that in this case, you have a slightly different view. I mean, the reaction's the same. The risk perception goes down, and the dollar goes down as well. And that's what we're seeing here, because after all, the Europeans, with Mr. Draghi, said something here. The euro is now higher, the dollar's lower. So you can make the argument that that's risk perception as well, and we haven't changed. I would say that if there is not another blow-up in Europe, and there's plenty of potential, which I'm going to talk about in a minute, this will be a change where the fundamentals, the economic fundamentals, start to come back. Okay, so now let us look briefly at the European debt crisis. My view on the next year or two, I'll say a year, is that there are potentially, let's put it this way, the risk environment has stabilized, certainly since last summer. We're not seeing any new events or any new developments since I think July in the risk environment. I mean, if you look at the move in the euro from here as a canary, as I said earlier, to here, That is a period of about 7 months, maybe a little bit more, 8, maybe 9 months. So if you look at that here, you've gotten similar types of moves over same amount of time in changing perceptions on the European debt crisis. So the question we have to ask are, on this particular topic, what potential is there specifically relating to the debt crisis and European debt levels that this will come up again? And that question, I think, from a specifically financial point of view, has probably been dealt with successfully by the ECB. At least that is what it appears to be now. But what could bring that back? And I will show you some of the things that I think could. Because after all, and this is one of them right here, recessions, and Europe's in another recession. Germany had negative growth, I believe, in the, let's take a look, in the fourth quarter and possibly in the first quarter as well. Let's look at German. Okay, here's German GDP year to year. So year to year, you can see what's going on. And this is, of course, all of the austerity budgeting in Europe, the slowing down in China, the slowing down in the United States. It's all part of the same picture. So slow economic growth. You know, somebody said in a column recently, and I'm going to borrow it, I forget who it was, that the response of the world central banks has been the Scarlet O'Hara to the recession and the financial crisis and everything else, has been the Scarlet O'Hara response. I'll think about that tomorrow. Things will be better tomorrow. And that is largely true. Now, they don't have a lot of choice. After all, they're limited to rate policy and its permutations that we've seen. They can't change the other things that need to be changed. So what they're attempting to do, what they've attempted to do from the beginning of this, is to prevent a collapse and do within their area of responsibility, create the best conditions, the best monetary conditions for growth. But that's all they can do. The Europeans have proven they can prevent the collapse of the euro. Whether that's a good idea for Greece and Spain is not my point. They have proven that they can do that, as any central bank can. As long as people don't lose wholesale confidence in the currency, the type of inflation that you saw in Germany and other places between the wars, then the central bank can do these things. With the U.S., again, lender of last resort to whom? The federal government. Nevertheless, has the effect. So they have created the best within their areas of responsibility, the best conditions that they can for economic growth. However, clearly, look at Germany. You can look at anybody here as far as economic growth goes. That's the U.S. This is year to year on the U.S. As you can see, the U.S. has performed better. This is the EU. Looks just like Germany. No coincidence there. This is France. I have two for France. Here's Spain. Ooh, much worse. Here's Portugal. Highly unpleasant. Here is Greece, probably the worst of all. Greece has been in recession for, according to this, since 2009. I think it actually is a little bit worse. This is year to year. So if you take the quarterlies, Greece has been in recession for close to 5 years, I believe. So, and just as, take a look at Japan too. Japan's kind of interesting. This Japanese growth. It actually looks more like the U.S. than anything else. And of course there's China. The chart has the same form. However, the Chinese chart bottoms out at 7.7 and is far above 0, but it looks the same. So you can see the correlation, which everybody knows and expects, between the world's economies, the world's national economies. But to take a look at the euro, the problem, of course, is that this type of economic growth creates huge problems for national finances. Let's take a look at Spain. Okay? That's year to year. Spain barely made it back to positive growth year to year in 2011, and now it's 1.6 below. We don't even have to look at Greece or Portugal for this. What does this do? Well, from a national budgetary point of view, I didn't want to bring up too many charts, but you can see how many charts I brought. That's why I didn't bring those up. But the point is the same. The reason I don't have Italy up there is because Italy is less than Spain, but it all has the same point. Negative economic growth, or slow economic growth, does two things, especially in the face of the unemployment, which is very common in the EU, in parts of the EU right now, and also the United States. Creates much higher social service costs, unemployment, all of those things, and it diminishes government finances because economy is not growing, tax revenues fall. So all of these two factors, both going in the wrong direction for a heavily indebted and deficit-bound country, over time, bring back the same problems. So Spain appears not to need a bailout right now. But if the economy doesn't, and this is where it brings back to what the European debt crisis and debt levels mean for the type of trading and the type of view we take of the world's currencies. Yes, it is a bit better than Spain. I didn't bring the Italian chart, Mr. Abraham, so I apologize. So unless we get returning growth, and the question for the world economy, of course, is where is it going to come from? But unless the European economies, and not Germany, but Spain, but Italy, Greece, Portugal, France, look at French growth. Unless we get returning growth, here we go, back to zero again, then all of the financial problems will come back, and they'll be worse. Because the government has that much more accumulated debt, because the economy is functioning at a lower level. After all, the Spanish economy is shrinking. The Greek economy is shrinking. Look at Portugal. The Portugal economy is shrinking. Look at this. The zero's up here. They have increasing, and all of the problems with this particular social model are exacerbated. So it's possible that things will get worse and start up again. So that is the threat to the euro, and that, of course, would bring a return to the risk-on, risk-off model. Now, as I noted, when we look at the euro in this period right here, I would make the case that until something changes in the future, right here we have a diminishment of the risk-on, risk-off model, and we're moving more to a central bank economic growth dominated. Yes, it's time. Yes, it's year to year growth is what's on the axis. To answer your question. If anyone wants these charts, I'll be glad to show them. These charts are all from Bloomberg. So we can return to that question, put it this way, the effect on the currencies, whether the primary model is people are worried about whether the world's going to blow up, or it's what they're paying attention to is central bank policy. it makes no difference for the directions of the currencies. It's very different as far as participation, who's in the market, psychology, what you're going to queue on to trade. Yes, that's all true. But as far as the result goes, the rising periods here are periods when the Europeans seemed to have some control on the European debt crisis, and the falling periods are when worries were increasing. So you have exactly the same thing here, although I will make the case that if the crisis in Europe does not flare up again, that this will be the point where there has been a return to focus on European and central bank rate policy rather than crisis mitigation as it is here. Okay, so central economic performance in the EU does matter a lot, maybe more than anything else, to the future about where we end up with what has been, for many of us, sort of the primary economic crisis of our working lives. I mean, I started working on Wall Street in 1988. Good Lord, that's actually true. Anyway, and that was just a year after the great financial crash, the stock market crash, not financial crash, of 1987. This, of course, will be, for almost all of us, unless, let's hope anyway, the great economic event of our working lives, as the depression, the stock market crash of 29 and the following depression don't forget, it largely continued for another 10 or 11 years, with another great recession and steep recession in 1937. So we are 5 years out. My guess is that this entire problem, in various forms, has another 5 years to run at least. Anyway, this will end up being a financial and economic event of our lives, compared to my grandparents. Let me answer that question. When the trend angle becomes more steep, it generally means that the steeper the trend angle, the less supportable it is as far as currency trends go. Meaning, the more likely you get profit taking, the more likely you get some sort of reversal. Now, the thing about this period right here, I mean, look at the steepness of that. Remember what this was. This is the end of 2008. December, more or less, of 2008. A little bit more, November, December. Market's very, very thin. Lots of bizarre movement right there. In a normal trading environment, one driven by central bank interest rate policy, you probably wouldn't get these, you certainly would never get this incredibly steep collapse. You usually wouldn't get it. Because this is most assuredly a fear and event-driven market, and here as well. So that's a definite difference. So, we are looking at two basic factors, I think, here as far as the euro goes forward, at least for this year. One is the economic performance. But even if the European economic performance does not pick up, if it stays negative, I think that you are not going to get a return to the type of bond market issues that we had before. Because the threat of the ECB to prevent that is credible. Not only is it credible, but it is not the type of market that you're going to take a risk on. After all, most of the private bondholders, certainly in Greece and the bailed out countries, are already out. I haven't seen any figures on what percentage of Spanish private bondholders are out, but I would bet that it's fairly high. So the holders of these, certainly in Greece and others, they're all official ECB, they're various Greek banks, but they're official or officially sponsored holders. And one of the reasons, just as an aside, why the ECB does not want to reduce the valuation of the bonds, take a haircut, not only for its own books, but for any of the European banks that hold those bonds, it's a huge hit on their capital. Because if you devalue a bond, if the ECB agrees to take a haircut on its bonds, and any bonds that are held on any official books also have to do that. And any remaining bonds, even if they've already had a haircut on private bank books, will also take another hit. So that's an issue that is unsolved. Now, okay, I'll just answer this last question with what I'm talking about here. This, I think, is probably the greatest threat here, and this is no longer a strictly economic threat. It becomes a political issue. You know, I have said since the beginning of the financial crisis, but certainly since the beginning of the EU crisis, let's take a look at this. This is EU unemployment. That the problems that no government, be it the Germans, the Greeks, or anyone else, no government will ever elect, no current government at any rate, none of the established European parties, political parties, will ever elect to leave the euro. Greece, by far the worst, did not elect to leave the euro. It will only take place. The Germans have been saying, threatening other members, but threatening is the wrong word. You can easily make a case, and I would actually, that the German point of view is correct because there's really no other choice. I know there are many commentators who say austerity is pointless, but from a political point of view, austerity will only happen. Austerity is hugely unpopular. It's unpopular here. It's unpopular in Europe. It's certainly unpopular in Greece. The place is probably popular is Germany because the Germans already did it voluntarily 10 years ago. You can say the same about Canada as well. So from an economic point of view, austerity is counterproductive, hugely counterproductive. But from a political point of view, from a generational finance point of view, it's the only way it will ever happen. In a consumer society, which we all live in, which we all have many, many things, from a spiritual point of view, probably far too many. Nevertheless, austerity is never popular. A measure of success has become more and more, the old line from the 80s, he who dies with the most toys wins. Rather cynical point of view, certainly a shallow point of view, but it is an accurate point of view in many ways for consumer societies. So from a political point of view, the only way to actually preserve the future is perhaps austerity now. Because once the pressure is off, there is not a democratic government in the West that seems to be able to change its spending habits. Certainly that's true in the United States. So the threat to the euro is, just 1 second please. This is the threat to the euro, right here. This is Greek unemployment. Imagine living in a country with that much unemployment. That's Greek unemployment. This is Spanish unemployment. And this is the official unemployment rate. It's much like the U.S. unemployment rate. The U.S. is 7.7. That's frankly nonsense. The reason it's 7.7 is because, and that's the official unemployment rate, that's one way of counting it, is because people drop out of the job market and the government stops counting them. It doesn't mean they don't want jobs. It just means they didn't look for a job in the prior month. They're probably depressed. They probably don't think they can find a job. In many cases, they can't. So the U.S. unemployment rate is somewhere probably between the actual unemployment rate, somewhere between 9.5% and 10%. The U6 rate, which is the rate for people who actually want to work but are working part-time, is 14%. This is Spanish. I would guess there are two views of this. One, that the rate is actually higher, and certainly the rate for young people, I believe 25 and 35 or 20 and 30, is double this. It's 50%. But what's true in Spain, and I've asked friends of mine this in Spain and in Greece, and what's true in Greece as well, is that it is a good measure, perhaps, of the unemployment rate, people who have are on the books for jobs, but it's not a good measure of access to earning, of access to funds. Meaning, there are probably a lot of people in Spain, a lot of people in Greece who are working off the books, whose economic state is not measured by official government statistics. And that is probably much more inevident than people realize. Because if you go, now, I mean, I've read stories. I haven't been to Greece in about 2 years, actually. I read stories in the newspapers, and I hear from friends that things have gotten appreciably, I mean, the social aspect has gotten much worse. There's much more crime. There are abandoned buildings. There's much more drug use. Parts of Athens, it's dangerous to go to, which never used to be true. Less so I hear of that from Spain. So there is real social change. But I don't think in Spain it's that dramatic. Now, I haven't actually been back to Spain in a number of years. The point being, for the political point of view, Greece will never leave the euro until they are so disheartened or depressed or have lost enough hope that they will elect a government, Syria, I think, is the party, that will leave the euro. The current European elites will never leave or elect to leave the euro. And that is the other key to the euro for this year and the euro trends, I think, this year. Because it seems so far that the central banks have successfully staved off yet another recession. And there's enough money in China to keep China running. In the U.S., there are enough sectors, primarily housing, that are improving, enough to keep the economy from heading into recession. And if the U.S. and China avoid economic recession in the next year, then I think things will gradually improve in Europe. And if that's the case, then the return, whether it is because of a lack of fear or because you're getting economic growth, will mean the same thing for the euro. The euro will probably recover. The only caveat to this, and again, we're now approaching what I've said a number of times before. Yes, Japan as well. As far as Japan goes, my favorite chart is the one I showed you earlier, the hopelessness of central bank rate policy. It's this chart right here. Central bank rate policy does not create economic growth. By its own, it cannot do it. Will not do it in Japan, and will not do it here. So the only caveat I would put at the moment to the withdrawal of the fear factor from the European debt crisis, promoting a higher euro and a lower dollar, which for the time being you can say is risk on, risk off, or is a return to central bank policy, either way, is when the Fed decides that QE will be withdrawn. Now, QE has not created inflation, but it will create large, I believe, a strong trend in the FX market if it is in fact withdrawn. So that would be the only caveat I see as far as the change in the euro this year. My last question for this was, the governments of the EMU nations have made their commitment to the united currency clear. Will it be enough to preserve the euro? At the moment, it appears to be yes, with the caveats that I mentioned. That European economies are performing very poorly, they're shrinking. That could, over time, meaning the next year, make the financial condition of some of the weaker European countries much worse. If that happens, if there is political or domestic turmoil, strife, riots, governments fall, Greece is a possibility. There's currently a scandal in Greece that could possibly collapse the government. Then these things will bring the crisis back. But aside from that, that is a good point as well. The Europeans are finding, of course, that as they handle or defeat, if you will, the debt crisis, the euro goes up, and that, of course, is bad for their economies. Well, as everyone knows, there's no free lunch in the world. There are no absolutes in any of these comparative measures, but they do foster change regardless of the fact that there are no absolutes. Okay, folks, I thank you very much. I think I ran over a little bit. I hope this has been useful. The recording of this will be up on the FX Street website. I'd like to thank Maud and Vicky for arranging this and for acting as sponsors. I hope you all have a nice day, and we will see you, I think, next week. Although I have not chosen the topic, it is not going to be on the euro. I'm going to go a little afield and look for something that does not usually get covered in webinars. Again, I thank you all very much for taking the time to attend, and these are something that I very much enjoy. Everyone take care.